Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Dadia. We have with us Mr. Sanjeev Verma, President and whole-time Director, and Mr. Deepak Kumar Bansal, ED and Global CFO at AGC Networks joining in. Welcome to the show, gentlemen, and a pleasure to speak to you and have you on the show. My first question coming to you is, every business somewhere has been impacted due to COVID. Some businesses have seen a positive impact. Some businesses have seen a negative impact. How has the transition been for you if you have to take into consideration the last 12 to 18 months?
Okay, I think that's a good question. Yes, so the transition has been pretty slow to start with. I think we are a people-led asset, so any transition requires that, how our people transition to that. I think it was something unprecedented. I think our offices still remain to be, kind of quasi-functional in some markets, and in some markets we still continue to operate largely remotely. On the other hand, our customers, some of them, of course, for example, in the US have started to open up, but some of them are still pushing ahead as to when they will actually mandate people to come. And it's kind of a bit of a confused state with regulations, government mandates, city-state mandates, stuff like that. And I think, having said that, I think with respect to our ability to learn and adapt to a situation, has helped us to transition to where we are to support our customers. Similarly, our customers have also learned to adapt to work remotely or get supported remotely. So from a transition standpoint, we're definitely better than where we started 12 months ago. But I think we still have a long way to go at this time. We continue to see, I think, the project starting to come back. It's been 12 to 18 months time. We have a lot of employees or support that we provide on site. We have transformed that into a kind of a quasi-hybrid model. We expect it to continuously improve, but I think overall the transition is still slower, and we expect it'll take some more time before we come back to accept the new normal of working in a manner that we have been doing now.
Right. So overall, if you go to see in terms of where business goes, one thing that impacted the company was the semiconductor chip shortage. How big an impact was that to your company?
So I think so there are two ways to look at it. One, of course, we have two sets of businesses. One, of course, our technology product business. We usually work on a cycle of 90 to 180 day of inventory lag. So I think so we didn't get hit immediately, if you may, but I think we have seen a delay in our product business between 4 to 8 weeks time, and it also depends upon the pressure we have had on the logistics and supply chain overall. So some markets have been affected more than the other. The US has been relatively less impacted compared to our Middle East or other Asian markets, because the supply on the US side, of course, because of volume, the suppliers are more inclined to supply towards this side. On our project business, where we partner with technology products, once again, we have seen some pressure in the US, but more pressure in our Middle East and overseas markets. So yes, there has been a delay between 4 and 16 weeks, depending which part of the world you are. The US impact has been a little less, the markets have been more. And I think we expect for the next 1 or 2 quarters, the semiconductor issue to continue to have some pressure on us.
Okay. And by when do you see the issue getting resolved?
I think over the next 2 quarters.
And has this actually had a change in terms of pricing as well due to the shortage?
Yes, so there has been some change in pricing as well. I think we are adjusting the prices based on that. So there has been some pain, not only just because of semiconductor, but overall supply chain, logistic freight, everything has moved up. So there has been a price change between 15% ballpark with respect to the raw materials and stuff like that.
Right. So all of these increases have been passed on, right?
I think it's, as I said, I think you cannot just pass on immediately the effect earlier on, but yes, now it has been adjusted and passed on. You're right.
Right. And overall, when we see your PNL as well, the finance cost on the PNL has reduced considerably in the last 2 quarters. And that's clearly reflected in your overall profitability as well. So number one, what has led to this reduction in terms of interest costs? And number two, is this something which is expected to continue over time from here on?
I'll let Deepak, my global CFO.
Yeah, thanks, Hiral. So, if you see our balance sheet, our debt have consistently been going down. In FY21, which was last year ending March, we repaid 286 crores of debt to the banks and financial institutions. So we close our debt at 176 crores at the end of March 21. We repaid further in the quarter 1 of this year. We repaid another 30 crores to the banks. So our debt levels have consistently been reducing. At the start of the FY21, our debt levels were at around 460 crores. Now our debt levels stood at less than 150 crores. So because of the regular reduction in the debt, our interest cost have substantially reduced. Our interest cost for FY20 was 123 crores. For FY21 it was 86 crores because it was gradually coming down. Now let's say going forward, our interest cost is going to be in the range of maybe 12 crores to 13 crores a quarter. That's what we are estimating interest cost as of now, basis the current debt ratio levels we have.
So what's the current debt to equity ratio?
So the current debt to equity is like we have a debt of only 145 crores, but we have the net worth of close to around 250 crores. So our debt is maybe close to around 0.6, 0.7 of our equity.
Okay. And overall, with regards to where, the two business divisions that you operate in, GSI as well as TPS, where are you seeing higher traction? What is the revenue breakup looking like right now?
Okay, so I think our two businesses, our product businesses are smaller. It is about 15% of our overall business. And we are seeing stability in both the business, but with respect to growth, considering the hyperactivity, more specifically on the cloud and data center side, we are seeing more orders or more hyperactivity on our project and services business.
Okay. And are you expecting the revenue mix to change in the next, say, 12 to 18 months?
We do not expect the revenue mix to change significantly. We expect to grow both the businesses, but the revenue percentage mix will possibly remain consistent.
Okay. Apart from that, and if you have to talk about your recent acquisitions as well, you acquired a US-based company, Black Box Corporation. What are the synergies of this acquisition? How much will it add in terms of our profitability, or say on the margin front or on the top line front?
Okay, so let me take that. So the Black Box we acquired in January of 2019, which is almost like 2.5 years back from now. So the Black Box acquisition gave us a huge growth and as well as the platform to grow further. And primarily we have increased our footprint with the Black Box acquisition in US, which is the world's biggest market for the services what we do, and also in Europe and Latin America, and expanded our horizons in APAC and other regions with respect to that. Now when we acquired Black Box, the Black Box was a public company in US. We made it private, and after that we really transformed the Black Box, because Black Box when we acquired was not doing good on the profitability side. So we really transformed the Black Box, and how we transformed really is a great story to tell in terms of what really we do and what really we come from. So we strongly believe on the ratio centricity on the manpower side. We have close to around 3,500 employees right now, including AGC, Black Box, everything together. And out of the 3,500 employees, a lot of employees are on site, which is on ground, serving the customers on a regular basis. Now what happens is that's why the ratio centricity becomes very important. We have, out of 3,500 employees, we have 2,200 employees on ground in US. We have the balance employees in Europe and all those where. So all these employees includes the technicians which go to the customer sites on a regular basis. Now what happens is that when you look at a ratio centricity, we need to maintain in terms of a specific set of the revenues, how much is the manpower required to serve that type of revenue. So what we have done after the acquisition, we have revisited those ratios. We have benchmarked with the industry standards. And then we have optimized the whole manpower, and we let go close to around more than 200 people
Wow.
within 6 months of our acquisition in US. And
Mhm.
that really provides us the efficiency. So the idea was that no impact on revenue, no impact on customer delivery, no impact on customer satisfaction, and then idea is to only increase the internal efficiencies to deliver to the customer. And that's where we have been able to reduce those people to drive the transformation and profitability in the company. Apart from that, we have been able to optimize a lot of costs here on ground, which includes the facility optimization, because we have almost 35 offices all across the US states, because we serve all the US states, all the 50 US states we serve. And apart from that, we have offices all across the Europe and all those things. So we optimized a lot of warehouses and a lot of offices in terms of the requirement of the space, which has reduced the cost. Apart from that, we revisited the procurement cost with the economies of scale, subcontractor cost, where we negotiated the margins with the subcontractors, the insurance cost, the administration cost, and then the IT and communication, we renegotiated the AMC contracts and all those things with the vendors. And then we also put in a plan with respect to consolidation of all the ERPs, because company was running on various ERPs. So right now we are working, or let's say we are almost through with a one ERP all across the company, serving the whole approximately around, let's say current revenues are in the range of around 5,000 crores we have. So the whole ERP, whole company will be on one platform, which is SAP, integrated with ServiceNow, integrated with Salesforce, integrated with Oracle HR, and all the other peripheral programs which support the businesses in terms of end-to-end delivery from, in our language, we say order to cash cycle. From quotation to order to procurement to delivery to service to the customer to the cash cycle. So that's how we are looking at it, from an end-to-end integration on the ERP, seamless integration. And then the another thing which right now is that basically center of excellence in Bengaluru and Mumbai. So what we have done is that in last 1 year period, we have started a center of excellence in Mumbai and Bengaluru to support the global operations all across, which includes the NOC and SOC, which is very critical in our business, which is Network Operations Center as well as the Security Operations Center. And there are a lot of work related to IT, R&D capabilities, marketing, finance, and all those things, and the order management, which is now getting served from India. And we will also continue to see that how we can have develop more capabilities in center of excellence going forward. So these are the synergies, I think, which as the overall thing coming upon. You would have seen that we have just announced also that as a part of the synergy and overall initiative, what we are really doing is that we have also, the board has also approved the change of the name from AGC Networks to Black Box Limited. So we are synergizing the whole brand and whole identity of the company also to a single brand all across the markets in all the continents and countries we are to single brand, which is Black Box. And so the company name after the shareholders approval will be changed to Black Box Limited from an overall perspective.
Right. So with this, another major acquisition that you made is in Z Services. Now, what are the synergies there? Because I understand it will strengthen your presence in Middle East. But apart from that, what other synergies are we seeing on that front?
So I think the Z Services acquisition is largely in line with our focus on new generation business, including cloud. It's a cloud services business on cybersecurity. One of the key areas of growth for us is cybersecurity. And I think so. It's not a addition for scale. It's an addition for skills. It's addition for our engagement model. So it gives us a footprint in the Middle East market for sure. But I think we have exclusive partnerships with cloud cybersecurity companies that we want to expand in the local market, but we're also working to expand that global partnership now to other markets. It's a cybersecurity cloud-led business, and as we move forward, one of the key areas of us to focus on is going to be cybersecurity. We're going to invest both in skills, both in our sales motion. We have a large customer set, both here in North America and otherwise. And I think these services brings in the element of understanding on the cybersecurity space. Also, it's a subscription annuity-led model. It also allows us to have long-term annuity with our customers in the cybersecurity space.
Right. So with all of these acquisitions, what is your strategy going ahead from here on with regards to where inorganic growth goes?
Okay, so I think we will continue to push in an opportunistic way as far as our inorganic growths are concerned, commensurate with our ability to deploy capital. I think our approach is simple. One, of course, our approach is to see that we are able to open up newer markets if we can, and therefore we'll see which markets make sense for us, and if there is something valuable for us to do there, either serving a customer or just expanding to a new market where we believe there is potential. The second approach or a strategy for us is to see that it's able to add up some depth of skills in the areas which we operate. And so that's again the second one. The third, of course, is scale. If we find something that can add some scale. But having said that, I think we are focused on economics-driven inorganic strategy, not emotion or ego-driven strategy. It should make economic sense for us. It should be accretive to us in a short-term time, and we should be able to transform. So therefore, I think keeping in mind that we're looking at either geographical expansion or solutions or skill practice that can come in or provide some scale. So that's the basic framework. On top of that, what is the key drivers to see that we are able to be economically accretive for our shareholders. So I think keeping that, we'll continue to look at opportunity. We do have a pipeline. We do have the wherewithal at this time, and we're exploring market, our strategy both here in in North America and some other markets as well.
So in terms of geographies, where do we see further expansion coming in for a black box?
Okay, so I think we are looking at going a little deeper as far as the APAC market is concerned. We are spread across in many markets. We operate in 18 countries, but we are fairly thin in some markets. So we want to see that we can become, from a perspective of 1 feet wide to getting into 1 meter deep. So we'll go deeper in some of those markets that we have. We're also looking at expanding and creating focus in Latin America market. It is a strong market for us. I think we are still, we operate in Brazil and some other smaller countries, but we have a potential there. So we'll continue to focus on the largest economies like the US, but we'll also continue to look at some of the growth market that we have, especially APAC and LATAM as well. From a perspective of as we look at from a solutions perspective, we also are following where our customers' footprint go. For example, the data center, if you see the hyper investment, India is also going to see that very soon, billions of dollars. So it is driven by customer demand as well. So we also follow a customer as to where the customer takes us. So we have been working in Sweden for the matter for the last 4 or 5 years' time. We have quite a bit of boots on the ground, and that was led through a customer, right? And I think we have a large customer of a very, very large potential there. So looking at the overall, where do we need to go based on the market situation that we believe there's a potential, where do we go based on what our customers want to be as well. But clearly we're looking at expanding in APAC, LATAM, and of course, some of the existing market that we have, we want to go deeper and wider.
Right, so that's going to be a great strategy to watch out for. Now, with this strategy, another thing that you're focusing on is think global, act local. Would you be able to elaborate more on this as to how are you implementing the same?
Okay, so I think if you look in perspective, when you look at the black box acquisition which happened, I think this strategy was kind of aligned post the acquisition. It was a very, very North American local company, right? It was serving customers out here, but many of our customers that we black box serve have a global footprint, right? But I think black box wasn't serving them globally, was serving them locally here in the US. The approach for a think global, act local is largely based on relationship and relevance. So the mantra is to be able to be closer to where the relationship exists, and it can exist in US, it exists in Europe, but to be relevant to a customer which has a global footprint. We have many, many Fortune customers. It is important for us that we think from a global scale as well. So I think we will continue to hold the relationship closely locally, but we will bring in the best practices, best processes, best cost model by using our global framework, and also therefore grab market share from the customer or share of wallet, serving their global needs. So that's the strategy, pretending to think globally but act locally, right? And I think since the last 2 years' time, we have had very many customers that we were serving in one market. We're serving more than one market, right? Because I think of our footprint, and we're augmenting that. Very recently, we've invested in people in Europe. I think we are very, very thin in some of the markets, and we are starting to see some of our customers from America flowing into Europe. And of course, we expect European, Asian, or other customers to be able to be served cross-border. So the whole concept of think global, act local is based on holding on or being closer to where the relationship exists, but putting in the best practices of global delivery, global processes, and of course, serving the customer from a globalization perspective.
Okay. And overall, with this strategy from here on, what's the kind of outlook we have for FY22 and what are our expansion plans?
Deepak, you want to take that?
Yeah. So the expansion continues to be from a overall expansion perspective. It's an organic and inorganic both. What we are looking to expand, and like what Sanjeev told, is that there's an investment going in the organic side, primarily to see that how we can penetrate our existing customers more in the markets where we are, and also from an inorganic side, wherever we get the opportunity to expand, or let's say if we found the right asset for us in terms of increasing our offerings, or maybe let's say to a transformation opportunity. So for that, we will continue to look at. Right now, from an outlook perspective, we are looking by end of FY23, we should be at a run rate of 7,000 to 7,500 crores of revenues. That's how we are looking at it, and our EBITDA margin to go up to 9 to 10% on of whatever the work we are doing. For FY21, just for a comparable perspective, we were shade lower than 5,000 crores. We are at around 4,674 crores of revenue, and our EBITDA margin was around 7.5% for FY21. So with all these things, that's how we are looking at it. So the idea is primarily to penetrate the existing customers, addition little bit in the new clients on the markets, the ride on the growth of the customers. And we have the marquee customers. You would have seen from our website also that we have the customers from all across the sectors, including the financial services, the technology giants in the world, as well as the hotels, restaurants, technology companies, the manufacturing companies, and all those stuff. And then obviously continue to optimize the operational efficiencies to see that we continue to operate on a ratio centricity, and then the EBITDA margin continues to grow. That's what is the overall strategy in terms of the targets.
Right. And overall, apart from these targets, any fundraising that we would be looking at in the near future?
So right now we are not looking for any more fundraising from as a strategy perspective, because we don't need as such, but we will look at in terms of continue to explore the right set of acquisitions if we can, and those acquisitions, if we need to raise some funds in the form of equity or in the form of let's say a little bit of debt, in terms of our strategy of not leveraging much, and let's say continue to maintain the debt equity ratios at around let's say 1.5 type of levels if we acquire the companies also. So with that, under that strategy, we will raise the debt if required to basically look at the acquisitions to support the inorganic growth.
Absolutely, and that looks like a strong strategy from here on as well. And in terms of being local, that's something which I think India is looking at as well. Thank you, Sanjeev. Thank you, Deepak, so much for joining us on the show. It was a pleasure to speak to you guys and get great insights from you. Congratulations once again for these milestones that you've achieved so far. Good luck and stay safe.
Thank you so much.
Thank you.
Thanks, everybody.
Thanks.
Thank you.
Bye.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.